Okay, hi everyone. I think we are ready to start the webinar now. My name is Joanna. I'm from Marketing Communications at Phillip Futures. I have with us Siew, who will be the speaker for today. Let me just give an introduction to the webinar that we are attending today. It's about a Q2 market outlook. Samuel will be discussing the major events that will impact the markets, what market risks there are that will impact countries like US, Japan, China, and Singapore, and what opportunities that you as an investor can look out for. Samuel is an analyst with Phillip Futures. He has been with us for about a year, and prior to that, he was an equity dealer with Phillip Securities. In total, he has about 5 years of experience in this, in the futures and the stock markets industry. Samuel, I hand over the time to you for the next 1 hour.
Thank you, Joanna. So a very good evening to everybody. My name is Samuel. I'm an investment analyst with Phillip Futures. So for today, I'll be covering on the second quarter 2018 market outlook. So before I begin the seminar, just a little disclaimer is that anything that's covered tonight will solely be for educational purpose. So before you make any investment decisions, please consult your relevant financial consultants. So a little bit about myself. I'm an investment analyst with Phillip Futures. So I specialize in the equities indices as well as the Forex markets. Daily, I provide actually market commentary on indices and Forex to our clients, as well as you may have heard me or seen me before on TV because I'm a market commentator. So I appear on Channel News Asia, as well as radio before, as well as the newspaper. So I also do conduct seminars. So these are some of the past seminars I've done, like the 2017 Invest Fair, as well as the most recent Lienhe Zaobao Forum. So for today's seminar, we'll be covering actually 4 markets: US, Japan, China, and Singapore. So we'll be covering it in this format, whereby we will first do a 2017 recap, as well as followed by the factors which will impact market in the first quarter this year itself, and our view and forecast for the second quarter this year. So a question is that what is the market view now? So some may say it's a bull market, some may say it's a bear market, but personally, I feel it's actually a kangaroo market whereby volatility is very high and the market is jumping up and down quite rapidly. So first about the US market, last year we actually saw markets actually rise. So if you have bought into like the mini S&P futures, you will have made approximately 20%, or even if the NASDAQ actually rose around 31%. And for Dow rose approximately 25%. So why was market so bullish last year itself? That's because last year we actually saw the rise of a new president. Basically, President Trump took over last year, and the Trump effect actually happened. So what is the Trump effect? Trump effect is actually President Trump being very pro-business and pro-US. So we can see that last year itself, he actually implemented some rules, such as the 2017 Tax and Job Act, which actually saw tax cuts for companies. We also, this has actually helped boost market sentiments, and you can see that markets actually outperformed quite greatly last year. And last year, he actually also have a lot of policies that actually benefit US itself and bring business back to the US, because that was what, when he was campaigning, that was what he was actually promoting. So also we saw that last year itself, there was no uncertainty rate hikes, so it failed to actually pull markets back and markets carry on booming. Because in 2016 itself, actually markets predicted 3 rate hikes, and last year we actually saw 3 rate hikes happen. So due to there being no uncertainty, markets carry on its bull run. Last year was also a year whereby technology stocks did very well. So we can see that FANG stocks actually outperformed due to the successful product launches. So like example, like you can see the FANG stock comprises of Facebook, Apple, Amazon, Netflix, and Google itself. So you can see that due to new product launches like Apple, they had the unexpected iPhone X launch and things like that. It actually gave more reason for markets to be bullish, and you can see that stocks for the technology sector actually rose by quite a bit, and that's why we can see that NASDAQ actually outbeat market, and it rose by around 30% last year itself. So how about this year? What's happening this year? This year we actually see that for the first quarter, markets actually fell by approximately 2%. So like you said, for S&P futures itself, and for NASDAQ rose slightly, but then if you monitored the first quarter, as in April itself, it actually fell below the start of the year. And for Dow itself, Dow in the first quarter, they fell 3%. So what actually resulted in such uncertainty, and why markets suddenly took a turnaround? Well, because of the fact that firstly, we saw the start of a new Fed chairman. So during there, I'll explain more later, and we also saw the implementation of the steel and aluminum tariffs. And you can see that actually there's escalating tensions between China and US. So this actually creates a lot of market uncertainty because throughout all of this, markets are feeling that maybe the good factors that Trump actually brought about last year itself may not carry on into this year. So during the start of the new Fed chairman, we can see that this year, Jerome Powell took over. So a little bit of background about him. He's a member of the Fed since 2012. And he was very upbeat about the US economy. So what does this mean? It actually means that that because he's thinking that the economy is going to rise, it shows that it's time for him to raise interest rates as well. And because a better economy warrants more tightening of monetary policies. So because of that, he also stated that the further gradual increase is the best way to strike a balance between an overheating economy and keeping growth on track. And so far, based on his first FOMC meeting, he stated that though he's still quite certain that he's not going to give any unexpected rate hikes this year itself, he actually increased the forecast of the rate hikes next year. So this actually caused a little bit of panic on the market, where markets are looking at the fact that Treasury yield or bonds may be more attractive than equities in the coming future because of the rising interest rate. And this has actually strained markets slightly. Also, we are looking at the fact that this year itself, you also see the implementation of steel and aluminum tariffs, whereby in March, actually President Trump came out and shocked the market by stating he's going to charge steel and aluminum tariffs. So this created fear of a trade war among countries because of the fact that if US is to start creating tariffs and everything on its trading partners, people are worried that the trading partners will do a tit for tat on the US, and this will actually escalate even greater. So just a little bit about the steel and aluminum tariffs. Actually, this is not uncommon. It has been seen before. So what happens is that back in the Bush era in 2002, actually President Bush at the point of time implemented a tariffs on aluminum itself. But if we look, there's many similarities, but some sort of like dissimilarities. The similarities is that for the Bush era at that time, he created one with a fixed duration. So he already knows that how long he's going to put the tariffs for. But for President Trump, he's stating it as very long. And also for the fact that President Bush did state that there will be some exemptions, but President Trump initially stated there isn't. But however, after signing of the agreement, there were some exemptions, and you can see that a number of countries were actually exempted. People with regards to the American Free Trade Agreement, they were exempted currently, and also the fact that like Korea, Australia, they were also exempted as of right now. And for the tariff amount itself, so for the Bush era, what happens was that he gave approximately 8 to 30% depending on the amount, depending on the country and various factors. Whereas President Trump was flat, whereby he wanted 25% for steel immediately and 10% for aluminum. But right now, as of present, you can see that a number of countries have been exempted. And if we look at the list of countries that were actually exempted, as well as part of the overall imports to US, we can see that, like example, you can see Canada, Brazil, and South Korea being three of the largest imports to US in terms of steel and aluminum. So as of right now, what happens is that Canada, as Mexico, etc., exempted. You can see South Korea also being exempted. So a lot of the huge trading partners that were actually importing steel and aluminum to US are actually exempted from the things. So one of the countries that are not exempted, so one of them is Japan, you can see China, but they make up for very little small percentage. So you can see that actually President Trump is also trying to mitigate the whole situation and sort of like exempt those that were that have imported to US the most. But of course, there are terms and conditions applied to the whole thing, and whether US will stand to be the ultimate winner of the whole situation, we have to wait and see. But just to show you all what actually this impacted markets and why markets are fearful is because in the past, during the Bush era, when President Bush actually implemented the steel and aluminum tariffs, we can see dollar as well as the US stock market actually took a plunge. So this is what happened. If you look here, this was when actually President Bush implemented the tariffs. And you can see the white is dollar index, and this is the S&P, as well as this is the red one is the Dow Jones, as well as the green one is the S&P. You can see it falling due to the fact that it impacted market confidence, as well as it impacted the imports and the steel companies itself. And you can see because steel is one of the materials that's often used, companies that use steel are also impacted. So it's only until whereby the economy felt the wrath of the whole situation that in 2003 itself, mid-2003, President Bush actually stated that he's going to lift the tariffs, and you can see that markets rebound after that. So if, like example, the tariffs is going to take a toll on entire markets, and if President Trump is still going to be equally harsh on this implementation, we can see markets reacting accordingly as well. This is based on history. So, and we can see that aside from the steel tariffs, it actually escalated into one thing that more people are concerned of, which is, and the incident that everybody's talking about recently that still has not been resolved, which is the escalating tensions between China and US itself. So we can see this is the timeline of what exactly happened. So back in January itself, we can see that the US actually started by having duties on stainless steel. Then after that, then they start taxing China on washing machine and solar imports, followed by finally they had the aluminum and steel tariffs. So China hasn't really reacted to it, but subsequently, after US proposing 25% duties on Chinese imports, China struck back. So what happens is that they actually unveiled tariffs on $3 billion worth of US products, and this is to counter the steel and aluminum tariffs, and of which it impacted the farm industry in US itself, because a lot of it is actually on fresh products like nuts, fruit, wines, as well as poultry. And after which, US subsequently said that because of this, it wants a tit for tat and actually proposed 50 billion worth of imports, and especially trying to arrow in on China's technology sector. So because of that, China actually said that if you're going to do that, I'm going to do a tit for tat. But at the end of the day, both countries have already stated that they do not wish for a trade war to happen. And a trade war would do neither parties any good. So therefore, if we look objectively at the whole situation, we tend to think a trade war will not escalate. And you can see that right now, actually, the US side have some consensus as well. And the Treasury Secretary is actually making a trip to the US, to China itself, to actually negotiate the whole deal. So it has actually eased market tension slightly, but this still remains as a wild card because we won't know how negotiations will turn out. And even though a lot of analysts, including myself, we feel that a trade war will not happen, sometimes the market is greater than us, and if it really were to happen, it would hit market quite badly because of the fact that if we look in the past in terms of trade war history, like example in the 1960s, whereby there was a chicken war. So what happens was that it actually all lasted for a few years before it actually ceased, and during that period, consumers suffered, companies suffered as well. So there were no ultimate winners in the whole thing, and this will actually impact stock markets greatly as well. So this is a risk for concern that a lot of people are worried, and every time you can see that if a drastic news were to happen, or something is to aggravate the whole situation, you can see markets reacting violently, and that's why markets have been volatile as well. And because of all of these uncertainties, whereby we can see that President Trump is going more into the protectionistic policies this year itself, we can see that markets are starting to react quite violently, and we are relatively bearish on US indices because of the fact that even though the good effect from the Trumponomics is still there, whereby we can see that tax cuts and everything will benefit companies, based on the current quarter earnings, we can see that markets are expecting much more from it. So you can see that even though the markets have been beating analyst expectations, the impact is still not as significant as compared to the start of the year, whereby the quarter four earnings were beating expectations. You can see markets rising. Right now, the quarter one earnings are beating expectations as well, but you can see market actually falling instead, because investors are expecting even a greater savings for companies. So because of its failure to meet investors' high expectations, you can see markets correcting accordingly. Also of the fact that the positive impact in the long run may normalize, as investors may not see that much hype going forward as well. Also, we can see that the potential risk is the US and China relations, whereby right now the matter has not been resolved yet. So if like it takes a turn for the worse, it's going to impact US indices negatively. If it doesn't have a very conclusive ending and it just keep hanging on the sidelines, we can see markets reacting to it as well, and it may not be very pleasant. Also, rising Treasury yield is a risk for concern, as the fact that if Treasury yield rise too high, people may sort of like decide to put their funds in bonds instead, and you can see a shift from stocks to bonds, and it will impact indices negatively as well. So just to show what are some of the actions China can do if US and China relations turn even more sour, is that right now what happens is that we all know that China holds a large percentage of US treasuries. So you can see that the white line is actually showing the total amount of treasuries that actually is owned by foreign countries, and you can see that China holds a large percentage of it, of which if China reduce its holdings, you can see that the overall holdings actually reduce as well. So even though there is increased tension, in the last month, China actually increased its holdings of US Treasury. But if it really were to come to the fact that at the end of the day, the relationship really turned sour, and that both countries are at loggerheads with each other, we can see that maybe China will start dumping some of the US treasuries, and it will impact US markets as well. So just a little example of what actually happened in the past when China dumped US treasuries is this graph over here. So back in 2016, during a period of time whereby there was margin restrictions in China, China actually dumped US treasuries, and you can see that the dollar as well as the US indices actually correct accordingly, even though there was no drastic dip and the economy was very good at that point of time. You can see that it remained like sort of stagnant. But going forward, if like markets were to react violently, and if China were to dispose of US treasuries, we can see indices correcting and maybe the dollar weakening in strength as well. So just to show, the next one is the rising Treasury yield rates. We can see that in recent days, the news have been reporting a lot about rising Treasury yield, whereby you can see Treasury rates are rising. And if Treasury rates rise too high, what it means is that the equities market or indices may start correcting, because people usually, stocks as well as bonds are two of the most common tools investors invest in, including companies, etc. So when one suddenly rise in terms of attractiveness, whereby if interest rate use, treasury use rise too high and it becomes very attractive, people may decide to shift from stocks to bonds accordingly. And if that happens, we can see stock market start correcting. So the probability of this happening at present right now is still muted. We expect that treasury yields will rise maybe until around the 3.15% mark, but the impact on sort of like the stock markets may not be that significant at present. But as time goes by, if risks start increasing, and if the Fed is more hawkish and everything like that, and if treasury yields rise even further, then we can see that stock markets will start correcting as well. So if we look at it, this is the most recent graph. You can see that stock indices as well as treasury yields are quite inversely related. When, like example, you can see if like for this side, whereby Treasury yields start rising, you can see stock markets start falling accordingly. So now when Treasury yields start to rise again, you can see stock markets start to correct. So if yields continuously rise, we feel there is a risk for concern, and it will have more selling pressure on US indices. So based on technical analysis, if we look at US indices itself, we can see that right now it's actually start of a downtrend, because you can see it forming lower highs and start forming lower highs, and you can see that if you look at the moving averages, you can see the 20 moving average failed to break above the 100, and it's starting to come down as well. And you can see right now what we are looking at is whether it can break through the 200 exponential moving average. If it actually breaks below that level, it means it may be the start of a downtrend and more selling pressure actually exists ahead. So for the Nasdaq, it's more or less similar as well. You can see that the markets have actually broken through the 100 EMA quite strongly already, and if it actually breaks through the 200 EMA as well, much more selling pressure as well as much more downside may permit for the Nasdaq. And for the Dow, same thing, it's all a similar pattern. So more downside actually exists from what we are looking at it. And with all the factors as mentioned previously, selling pressure is still quite strong, and there may be more downside risks. How about for the USD? Well, we feel that for the USD, our view is still bullish on the USD, because of the fact that right now, due to the tax laws, we see potential cash repatriation plans by companies. Because what happens is that last time, if you earn money overseas, so like example for Apple, if they sell iPhones in China, they will actually earn Chinese yuan. So what happens is that they will store all of this foreign currency in the foreign banks, etc., not bring it back to the US. Because if they bring it back to the US, they would have to pay approximately 38% tax, which is not very worthwhile for it. So what President Trump actually stated is that if this year, if you bring all your cash back to the US and a one-time off, they would actually give like a consensus rate of 8%. Instead of 38%. So this actually increase the potential for people to bring it back, and they have to bring it back by this year. So if companies actually do repatriate their cash back to the US, it would actually give a strong demand for the US dollar, and the US dollar would rise, would strengthen as well. And also you can see that right now, what happens is that President Trump is actually fighting for the fact that he wants Republicans to actually still control the House and Senate during the midterm elections in November itself. So he has to definitely produce some results, and of which he's trying to show that the US has still strong economic data. And if with strong economic data, theoretically, it would actually give strength to the US dollar, and the US dollar would rise. So we can see that economic data in the US is still very strong at present. So you can see unemployment rate right now is at a 17-year low of 4.1%. And you can also see that GDP growth has been constantly growing, and it's one of the second longest cycle in history at present. So, and manufacturing, which is one of President Trump's focus, he wants to bring manufacturing jobs back to the US. It also has been very strong. So since end of 2016, it has been rising already. It's rising for around 17 consecutive quarters. So it's a relatively strong result. And if we look at it in terms of the US rate hikes, this year, right now at present, they are thinking that they're mostly going to have 3 rate hikes. But however, it may increase. If, like example, if Powell is more hawkish, and if they really increase, it will give further strength to the US dollar. So right now, we finished the March one. So there are still 3 more dates left whereby it's possible they will raise rates. So people are looking towards actually the September one or the June one as well. So why these 4 dates are very important is because of the fact that this four dates actually has a press conference release after the meeting itself. So it makes it easier for the Fed chairman to actually tell reporters and to actually tell the public the rationale for their rate raise, as well as their outlook on the economy itself. So you can see that last year itself, Yellen actually raised rates in March, June, and December. So this year we may be looking at the same. So the June in June itself, they may but the chance of them raising rates is actually quite high, and markets will be actually looking at September. In September, if they raise rates, it means that most likely they are raising rates 4 times this year, and if that happens, it will give further strength for the US dollar. So in terms of, if we look at the US dollar index futures, which is actually the dollar index, we can see that it has actually shown signs of bottoming. So like example, if we zoom into this area, you can see that a triple bottom technical pattern actually starts forming. So if this actually happens, so you can see that the target price is actually at the 92.236 region, because you can see one bottom here, second bottom, and the third bottom. So it's actually already broken the neckline, and we see more strength for the US dollar itself. And why is this bottom, which is this 127%, so strong? If we look at a larger picture, we stretch the date to be even longer, we can see that based on Fibonacci retracement, this is actually a 50% mark, and it gives a lot of strength and support for the entire index. So you can see that right now is actually slightly bottoming out, and then you can see it forming an upward trend pattern. So what we have covered so far is that for the US market, we are actually bearish on the index itself, but we are bullish on the US dollar. This is because of the fact that there's still potential headwinds from increased tensions between the US and China, as well as the rising Treasury yield rates. However, the cash repatriation plans by companies actually give strength for the US dollar itself. Moving on, for the Japan side, you can see Japan indices actually rising approximately 20% last year in terms of the Nikkei itself. And why? It's because there was continued Abenomics. So just to share with you what is Abenomics, Abenomics is actually issuing monetary policy in terms of the fact that they are having more aggressive monetary policy, and also it generates helicopter money, meaning they issue it's just like the US last time when they do QE, but QE, we all know that they issue they print money and they use the money to buy treasury bonds, etc. But for Japan, when they issue money, they are not buying treasury bonds, they are buying stocks, they are buying equities in terms of funds and everything like that. So it goes back to the equities market and gives strength to the overall Nikkei index. So because of that, you can see that so long as they continue Abenomics and helicopter money, it will give further strength for the Nikkei index, and you can see that's why Nikkei actually grew last year itself. Also, we can see continued growth in the manufacturing sector, and if you look here, you can see that their manufacturing PMI has actually continuously increased, and it's actually beneficial for the Japan economy, who actually thrive on manufacturing itself. So how about for this year? This year, we can see that from the start of the year till now, the Nikkei actually dropped approximately 6.25%. So what's the rationale? Mainly is because of the fact that this year we see that actually we can see that President Abe has been struck with a scandal. So last year, when he was re-elected, it gave confidence to markets because Abenomics is going to carry on. Right now, when he's struck with a scandal, it actually it sort of like give pressure to markets, because what happens is that not only has Prime Minister Abe actually lost quite a number of his key personnel due to various scandals, like the most recent being one minister who resigned due to a sexual scandal. What happens is that he and the finance minister have been facing a lot of calls to resign because of the fact that they were deemed to be having given exceptional favors to people they know. So it has also caused markets to feel that Prime Minister Abe may not be re-elected during his party's nomination in September itself. So if that really fails to happen, if he really is not nominated as the chief of the party, it will mean that he will no longer be able to be prime minister, and the overall country's direction may change as well. And if they don't focus on Abenomics, it is quite detrimental to Nikkei itself. We also can see that last year, when actually President Trump, in 2016, when President Trump actually was elected as president, so what happens is that the first world leader to visit President Trump was Abe itself. So a lot of people thought that Abe and President Trump would share good relations and everything like that. And it's actually beneficial for the overall Japan economy as well. But this year, we get to see that during the aluminum and steel tariffs incident, Japan was not exempted from the whole tariffs, and because of that, it actually caused markets to worry that this will actually impact Japan's standing, and especially the fact that President Abe is involved in the current scandal. It actually also puts pressure on him to actually secure some economic deals and everything like that to garner people's confidence and votes as well. So if he fails to do it, we can see that his standing may drop. And in fact, right now, his standing is actually at one of the worst state ever, and a lot of market watchers are actually worried about that. But however, we are still bullish on Japan indices after the scandal concludes, because of the fact that if you look at the overall Japan economy as a whole, it's still very strong. One of the rationale is because of the fact that the government is actually putting into more construction projects, and they actually have approved a record budget, etc. So recently, I just came back from Japan. So when I went to Japan, I noticed in Tokyo City itself, a lot of constructions were being done. And in fact, I see a lot of changes as compared to when I went there last year itself. So what exactly happened is the fact that we noticed that a lot of them are preparing for the 2020 Olympics. And when that happens, you can see that the economy will continue to thrive, because by having more construction projects, they are actually reviving the economy. And if they are doing so much, they're also expecting that in 2020 itself, tourism is going to increase. And right now, they are actually promoting an English campaign when they are actually their railways and everything have a lot of English and whatnot. It's because of the fact that they are aiming to be more touristy, and all of these are going to give life to the entire Japan economy and make it more vibrant. So because of that, it actually gives strength for the overall Japan economy, and it's actually a catalyst for the Nikkei index. And you can see that the policies are also becoming more pro-business. So we can see that in 2017 itself, what President Trump did for the US that actually gave strength to the US indices is that he actually cut corporate taxes and tried to attract businesses to the US. So Japan is the same. Japan actually is sort of like proposing that they would like to have a reduction of corporate tax, but through incentives, unlike what US has done, where they give direct rebates to companies. Right now, they're going to do it through incentives. So it's actually going to be one of the weighing factors, whereby if companies, they would like to come back to Japan or start a business in Japan, it can be one of the considering factors to actually pull them to choose Japan instead of other countries. Also, we can see that there has been no indication to shift away from Abenomics yet, because you can see that the Bank of Japan's Kuroda, what happens is that he is like looking at towards trying to lift the cooling measures. He wants to ease off. He wants to actually stop QE and everything should inflation rate be met. But right now, if we look at inflation numbers, it's still quite far away from his target. So the target is actually 2%. And if we can look at the recent numbers, inflation actually took a dip again, and right now, and as of March, it was just at 1.1%. So you can see it has to almost double before they hit their 2% inflation target, and it may need, and some time is needed for that to happen. So in order for them to stop Abenomics, more time is needed, and because of that, it's actually giving strength to Nikkei as a whole. So we have to wait for a while for the actual scandal to actually come to a conclusion, or for it to die down slightly, and we can see based on fundamentals, there will be more strength for the Nikkei itself. So if we look at the chart based on technicals, we can see that the chart is relatively bullish, because you can see a bullish crossover forming right now, whereby you can see the 20 EMA crossing the 40 and 100 EMA. You can see that as of April itself, after March, we can see the index actually crossing the 200 EMA to show that the trend has turned bullish. So because of all of these factors, we can see that actually there's still buying strength for Nikkei at present. And maybe you can see Nikkei with all the good fundamentals growing in 2000 for the second quarter of 2018 itself. So long as the scandal is controlled, because the scandal still remains as a wild card. So for the Japan market, we are actually bullish on the index itself, and because we see more government projects and job creation expected, and there's also no indication to shift away from Abenomics at all. However, the bullishness will only kick in after the fact that if the scandal remains under control. How about for China? Anybody knows if, like example, last year itself, which is the index that performed the best, and that is China itself. So you can see China actually exceeded expectations, and the A50 actually grew 33% last year. The rationale is because we see three factors. The first one being leadership stability in China, whereby last year during the 19th CPC, they actually establish leadership stability. You also can see that there's a opening up of China's financial sector, and the fact that China's overall GDP growth is increasing, and the economic outlook has also been given upward revisions. So what happens is that last year during the April-May period, it was announced that China will be included in the MSCI index from this year, May onwards. So what happens? It means that last time, if you would like to invest in China markets, the only way you're able to do so is either you are a China citizen and you invest in China markets, or you can do it through the Hong Kong Stock Connect. Whereas right now, it actually, by including in the MSCI, it actually allows a lot of people to just invest in China markets itself. So fund houses, what happens is that right now, if they would like to invest in China markets, they could just buy the MSCI fund, which actually the underlying is the China market itself, and they're able to just invest in it. So this will actually give a lot of buying strength, as well as the fact that more demand for Chinese equities and Chinese products. So by doing so, it actually exposed the Chinese market to, globally, and it actually gave strength for Chinese indices last year itself. And also, we can see that China growth was actually spectacular last year, and the World Bank, in fact, revised economic revisions twice and give upward revisions. This is because of the improved external environment and the strong domestic demand itself. Also, the fact that more efforts were made to rebalance the whole economy, and the strong service sector and fiscal expansion actually gave rise to improved economy and the fact that China has much more room for growth. So with improved economic forecast and everything like that, China indices grew. And we can see that it also beat President Xi's target. So President Xi for 2017, he set the growth target to be 6.5%. However, if we look at what happened in China itself, last year, they actually grew in the first quarter by 6.9, second 6.9, third quarter 6.8, and last quarter 6.8. So it actually beat the actual growth target, and it shows that China's economy is continuously still expanding and give rise to a lot of positive factors. But however, what happens is that this year, in the first quarter, China indices actually started correcting. And the main rationale is because of the fact that of a few factors. The positive factors would be that the precedent limit has been scraped, so it gives room for President Xi to actually give more control and plan his policies longer. So it's actually a good thing. However, two factors actually saw markets decline and give selling pressure for markets. One of it is the debt concerns, and second thing is the environmental tax that kick in from this year itself. So just a little bit about the debt concern. The non-performance loan issue has been highlighted on various occasions in China in 2017 itself. So what exactly it is if we look at the graph itself, we can see that China debt has been expanding, and expanding at a rapidly fast pace. So if we look at household debt, in 2012 itself, it is approximately 30%. But if we look at 2017, it has almost doubled to around 49%. So this is a very scary rate of growth. And if we look at national debt have also been increasing quite drastically. So in 2012, it's approximately 200%, but back into up to 2017, it has risen by more than 65, around 65%. So this has created concerns that the debt in China may implode, and because of that, it will actually impact the Chinese economy. And if we look at what happened in the past, whereby if we see how they control the debt, they do it by margin reduction. And one of the most classic example was in 2015, whereby actually they reduced margin to restrict borrowing. So in 2015, I was actually in equities. So every day I receive phone calls from people who want to sell equities, Chinese equities, but they're unable to do so. What happened is that because of the margin requirements reduction, people have to actually cough up a larger amount of capital. So a lot of people, when they actually buy equities in China itself, is actually based on margin. So right now I have to increase the initial margin before I'm able to continue holding my original position. So what happens is that they will have to top up. But if they have no money to top up, what happens is that the stock house will actually force sell their shares. So what happens, because of the fact that a lot of people don't have spare cash to actually top up, forced selling occurred. And you can see that because of that, from the peak, every day the shares were forced sold, and we can see 暂停, which is a trading halt. So when my clients call me to sell, a lot of times we are not able to sell it because trading halt. I can see from the peak to around half a year, what happens is that the equities market fell by 45%. So a lot of people are worried that this will happen because of the high debt, and that China is going to have restrictions on borrowing and everything like that. But we can see that this year, even though the regulations start kicking in, the impact is not as great as last time, and because they're doing it in a more controlled approach. So you can see that markets are more controlled as well, but it has failed it still actually caused a sell-off in A shares itself. And we can see the next one will be the environmental tax. So from this year onwards, what happens is that they actually implemented environmental tax. So companies will have to pay around 4 times more tax than last time itself. And we do know that the manufacturing sector is one of the key sectors in China. So because of that, it's expected to slow down GDP and manufacturing data. And if you look at manufacturing data itself, we can see that since the start of the year, the manufacturing PMI has been impacted negatively because of the environmental tax. However, what caught everybody by surprise is that the GDP continuously to rise, and I'll talk about it more later. So right now, what happens is that we are bullish on China indices, and you may be wondering, how come after the first quarter, after so much negativity, why are we still bullish on Chinese indices, especially with the high debt and things like that, which make it sound so scary? Because of the fact that right now it's under control, like explained earlier, and the fact that a lot of the government regulations are actually trying to fine-tune the debt ratio, and the fact is that a lot of companies are actually adjusting to it, but they are going it by a gradual approach. It's not so sudden, and because now they are dealing with corporates instead of retails, so it's a lot of the corporates actually have holding power and have a spare cash, so they just have to relocate their funds accordingly. Also, we can see that as of present, they are also controlling their monetary policy, and the Chinese side have actually slashed the reserve requirements for banks. So this will actually benefit the financial sector in China itself. So because of that, we see a potential rise in the Chinese financial sector, and will give strength to the overall A50 index. Also, we can see China start diversifying its investments. So a lot of people are worried because of the fact that right now, China and US are at loggerheads with each other and rising tensions, as said just now. But China right now has started diversifying its investments. So you can see that it has topped US in terms of Japan's stock export market, etc. Is building, is slowly diversifying, so it's not so reliant on the US. So if anything were to happen, it still can go to other countries and everything like that. And we can see that if we look at today's news and everything like that, Alibaba's Jack Ma actually was advocating that chip producers actually should Asian chip producers like those in China and Japan should actually up their production and everything like that, so that they will not be overly reliant on US, and US will not have a edge over the Asian market. So actually all of this is China's way of actually diversifying its investment. And once, if anything were to happen, it won't have all the eggs on one basket, and it's able to mitigate its potential sell-off. Also, we can see that Chinese indices as of today, it has actually corrected approximately 17% already. So actually this gives a good reason to actually start the buy up, because it has already corrected from its peak, which is actually quite significant. And with future strength in China indices because of the catalyst, it would actually propel China, it may cause Chinese markets to recover. So also we can see that there's strong GDP growth despite the government regulation itself. So if we look that, remember just now we were talking about environmental tax, of it hurting manufacturing, and the fact that they are clamping down on debt, etc. We can see that it has not impacted GDP growth at all this year. Last week, China released its GDP growth, and you can see that it's at 6.8%. So it's stable from last year itself, and shows that actually Chinese market, despite it's changing in terms of from manufacturing, they want to concentrate more on service and concentrate more on quantity as of quality. It still is not derailing their growth tracks at all. And we can see potential projects like the One Belt, One Road, etc. It's going to give more strength for Chinese indices. But nonetheless, the potential risk is still US-China relations. So you can see that US is still, based on last year, it's actually China's top trading partner, and nearly 20% of China's export actually go to the US. So if a trade war ensures, US GDP growth would drop by approximately 0.5% as warned by the IMF. Nonetheless, with China diversifying at present, even if things were to go out of control, we may see it maybe not as drastic as what people are thinking. And the fact that China's economy is big also, so it's able to sustain itself, and maybe sort of like with Asian countries supporting it, is able to mitigate its losses, as well as keep things sort of like minimizing the impact it has towards the Chinese market. So if you look at our A50 futures forecast based on technicals, it has actually broken through the uptrend line in January itself. But you can see that it has shown signs of bottoming. It has actually found support at 38.2% Fibonacci retracement levels, and it started rebounding. And you can see right now it's attempting to break through the 100 exponential moving average, and has broken through the 20 exponential moving average. So what we are looking at is it retracing and hopefully touch the bottom of the uptrend line and see whether it can break towards it. Because if we look from the peak to here, it's already corrected approximately 17%. So if it shows more bullish strength due to the catalyst and everything like that, we can see breaking over the resistance and hopefully break through the very strong resistance of the previous high itself. So this had more catalyst is required, but at present we feel that growth is still strong in China itself, as seen from GDP numbers, despite the increase in regulation and controls. So if we look at China, we are bullish on the index because of the fine-tuning of monetary policies by slashing their reserve requirements. This will give strength to the financial sector in China itself, as well as the fact that there's continued growth beside government regulations, and this actually will give strength to Chinese indices. Also, one thing to note is the potential risk, which is the US and China relations that it still haven't reached a conclusion yet, and hopefully it will end with a peaceful ending. Because right now what happens is that the US is actually sending its Treasury Secretary to China for negotiation. So back to our local markets. So in terms of local markets itself, I'm sure many of us will be invested in local markets. So last year, if you have invested in the Simsky futures, you have made a tidy profit of approximately 20%. So what happened in 2017 and why it's so beneficial for local markets is because of the fact that in 2017 itself, our Prime Minister actually reaffirmed relation with two of our main trading partners, namely China and the US itself. So you can see that because of all of this, it actually gave strength to the entire Singapore economy, and it caused the Singapore economy, the growth and everything, GDP growth and everything, to be revised upward one time itself. And this was also the fact that our Nordex numbers and our PMI numbers were the key drivers for the Singapore market to actually rise. So if we compare 2016 and 2017 itself, if we look at our Nordex numbers, you can see that in 2016 itself, we only had positive growth for 4 times. But if we look as compared to 2017, we had positive growth in about 12 months. So you can see that because of this, it actually gave strength to the overall export numbers, and export is one of the key factors that people look at in Singapore because it gives rise to a lot of in terms of GDP, in terms of jobs, in terms of manufacturing, because we are still known as a port nation. So with increased exports, it will be beneficial for Singapore numbers. And if we look at our manufacturing actually rose a lot last year itself. So many people may ask why suddenly our manufacturing rose so much last year. It's because of the fact that Singapore, last year itself, we excelled in terms of semiconductors. So we must know that it's not that Singapore is exceptionally good, but overall, the industry actually prospered a lot last year because we had an unexpected product launch last year, which required a lot of semiconductor usage, namely the iPhone X. So because of an unexpected product, because we must know that Apple actually launched one iPhone every year, but last year it launched 2 new iPhones, and one of it being the iPhone X. So because of the increase in demand, we can see the overall Asian semiconductor industry actually boomed last year, and it actually aided Singapore in terms of manufacturing, and we can see our numbers rise. But this year it may be muted because of the fact that we may not see such catalysts present. So how about this year? What happens is that this year, despite most markets falling, we can see that the Singapore market actually rose slightly, approximately 0.48%. This is because of the fact of 3 main things. One is that we actually signed our TPP to replace the TPP. So it actually gives strength because it means that trade will be secured. Also, we saw that the budget which took place in February itself, there was no major things to derail markets. In fact, it's an expansionary budget. So it means that there's more room for growth for Singapore economy. Also, during the budget, before the budget itself, many investors were worried, and analysts were worried that they're going to raise GST in this year itself, but it did not happen, and we were reassured that there were no GST raised and they only consider raising GST from 2021 onwards. So because of that, it actually caused markets to have more confidence, and you can see that markets didn't fall that much. But right now, we are still looking at a sideways markets for Singapore indices because of the fact that economic growth is expected to slow down as compared to last year. Because we see that last year itself, Nordex numbers and export and export and manufacturing numbers were so strong, it created a strong base effect. And this year, we may not be able to replicate such successes. So we won't know whether there will be any more unexpected product launches and everything like that. So we would see Singapore markets maybe not performing as well as last year. Also, at present, we lack a catalyst to actually spur markets on. Sorry. So if we look at what is a high base effect? High base effect is the how much you have to grow. So if we look at our GDP growth last year, we can see that in 2016, we actually start growing. So because just an example of what high base effect is, if like example, you earn $1 this year, and if you earn $2 next year, what will happen is that you have an increment of 100%, correct? So if you want to have an increment of 100% this year, you would need to double from 2 to 4. So you are actually growing even much more than your previous year. So this is actually what high base effect is, and we can see it apparent in our GDP growth last year. So 2016, we grew by a lot in the last quarter. So in the fourth quarter last year, we can see that GDP growth start to slow down. But in our first quarter last year in 2017, we can see GDP growth slow down slightly. So this year it increased slightly to show that we are still slightly maybe on track. But going forward, we can see that the main raise in GDP as well as export numbers, everything came from the second quarter onwards. So because of that, we are expecting that the high base effect will impact our second and third quarter this year, and it may drive markets lower. So if we look at our Nordex numbers, it shows it quite obviously, whereby we actually show positive numbers in January itself, but in February and in March, we are showing a negative Nordex number. So it's actually showing that our exports are slowing down. So it will eventually impact various sectors, like explained earlier, that trading is one of our more important sectors. So we can see manufacturing numbers, etc., maybe starting to slow down as well, and it will impact the economy negatively. So if we look at our, based on technicals in terms of Simsky, we can see that actually it's following this upwards channel quite closely. So every time it hits the bottom of the channel, it start to rebound, etc., kind of thing. And right now, people are looking at this, whereby people are saying that it slightly went up, so it may hit the top before dropping down again. So for the second quarter 2018 market outlook, for the US side, we are bullish on the index as well as the dollar. No, we are bearish on the index, but we are bullish on the dollar. This is because of the fact that there's more headwinds with regards to US-China relations and rising Treasury yield rates. However, because of the repatriation plans by companies, it will give US dollar strength. For the Japan side, we are bullish on the index because there are small government projects and job creation expected, and there's no indication to shift away from Abenomics yet. For the China side, we are bullish on the index. This is due to the fact there's fine-tuning of monetary policies, which will give strength to the financial sector in China. There's continued growth despite government regulation, and the fact that there's a potential risk in US-China. However, there's a potential risk in US-China relations. For the Singapore market, we think that it's a sideways market still, and that's because the growth in 2017 may not be sustainable, and there has been a lack of catalyst for Singapore markets. With that, we have come to the end of the market outlook portion. So I would really appreciate if there's any questions, please post it, and I'll take time to answer every single question. And meanwhile, I'll explain a little bit about our futures products, because now that we've known what is the outlook, we can use products to actually act on it. So futures is one of the ways. It's because to explain a little bit about futures, futures is actually derivatives. So their value is derived from the underlying asset. So like example, indices, and the fact that they are leveraged, so it makes it more affordable. And they allow bi-directional trading, meaning you're able to long and short. So it's one of the tools to leverage on shorting the market and to actually be exposed to the markets. So there are many types of futures we offer. We offer stock index futures, currency futures, energy futures, interest rate futures, agriculture futures, and metal futures. So the advantages is that it's leveraged, it allows short selling, there's a variety available, it's transparent because it's a market exchange and there's liquidity for it. However, the disadvantage is because leverage is a two-edged sword. You can lose more than what you put in as well. It's regulatory, so some people don't like because it follows regulation. There's physical delivery for certain things, and it's volatile. So an example of how futures actually replicate the actual index, we look at the Simsky futures, which tracks the Singapore index. So you can see that the constituent is similar to the STI itself, and it comprises of household names, DBS, OCBC, UOB, and Singtel, which is what STI comprises of as well. So you can see that the correlation is approximately 99% to the STI. So it's you can use it to actually leverage on the index. So you can see that it's exchange regulated because traded on HKEx itself, and you can use it for hedging and speculating. So by hedging, if like example you have stocks and everything like that, and if you think the market is going to go, is going to be a sideways market, you want to short, you can short the futures to hedge for your portfolio of stocks. Or you can speculate. If like example you think market is going to go down, you have no position, you can actually short the market using futures. So with that, I'll start taking questions. So yeah, I'll take a look at the questions. So how I'm going to go about doing it is that if like there are any questions, please feel free to actually post it over there and I'm able to answer. Okay, so I've seen one question is about the Eurozone outlook, correct? So for the Eurozone itself, what happens is that we saw that last year, Eurozone actually benefited in terms of policy. So you can see that what happens is that last year there was a lot of elections going on, and all of them, at least the extreme lefts didn't win. So it actually gave a lot of certainty to markets, and Europe actually rise. This year itself, what happens is that we are still bullish on Euro indices as well, because of the fact that one, there's less election going on this year, and we can see that even though the recent election in Italy, they hit a standstill, but then it's still, at least the far left didn't win, and they are able to sort of like have much more certainty. We can see that this year Germany itself, a coalition government actually formed as well. So you can see that the largest economy in Europe is gaining stability, and all of these are giving strength to Europe. So you can see that a lot of people may be worried that Brexit will affect Europe itself, but we can say that the main impact on Brexit is going to be UK and not so much on Europe. So because of that, we can see much more strength for Europe this year. So
we have another question from Irene Tan about Malaysia outlook. Samuel, could you assist to answer that?
All right, sure. So for Malaysia outlook, I think a lot will still be on the election, which is going to happen 2 weeks from now. So what happens is that it would be dependent. If, like example, stability is ensured in Malaysia, then I would see more room for Malaysian growth. But however, Malaysia is also very dependent on oil. So oil outlook will impact Malaysian indices. Right now, the oil outlook is still quite bullish. So if the political side is resolved, we can see that much more strength for Malaysian indices and the Malaysian market entails.
Okay, we have Mr. Tian who is asking about the US index. US index is bearish. Does this mean that the US economy is not doing too well,
Right.
Samuel?
So if that's the case, we actually feel that it's not so much on the US economy that's not doing too well that's impacting the US index, but like explained in the earlier part, it's more of the uncertainties of Trumponomics. Because what happens is that right now we are looking towards that President Trump is looking at a lot of protectionistic policies. So because of that, we can see it's causing the US market to face a lot of volatility. In terms of economic numbers, it's still doing relatively well, but the thing is that it's going to benefit the dollar, and the index is moving more by market sentiment. And because of the fact that Fed is raising rates and is more hawkish, we can see that it has pushed up Treasury yields, and this will in turn cause a diversion from equities to bonds, and it may cause downwards pressure for US indices itself.
Okay, we will take one more question in view of time. We have some questions about the Hang Seng outlook as well as China and Japan. Okay, let's answer the question first about the outlook for Hang Seng index. Samuel,
all right.
Maybe just a quick one.
Okay, so for the Hang Seng itself is pretty much dependent on China, because we have to know that the Hang Seng index and China index are quite closely related in terms of the government structure and things like that. So we can see that the Hang Seng Index right now, we still see more room for growth as well because of the fact that we can see a lot of them actually, what China is trying to do now is trying to get back some of the high liquidity stocks back to China. So it's also going to benefit the Hong Kong market because people will also use the Hong Kong stock connect to trade China indices, and overall it's going to benefit the Hong Kong market as well. And we can see if China continuously perform well, people will also turn towards alternatives like A shares in Hong Kong as well, and so it will benefit the overall Hong Kong market. So with regards to
bullishness on China and Japan, whether it will be hampered by US equity weakness. This will be the last question.
So the last, with regards to China and Japan being hampered by US equities, we can see that for China itself, one of the key risks that we are worried of is still the US and China relations. But if it is not going to impact it greatly, we can see that China's strength is actually not very much dependent on the US itself. So if you look at past history, you can see that China indices and US indices are quite not correlated at all. So because even if US continuously to face pressure and everything like that, if China's economy is doing well and if the One Belt One Road runs smoothly, we can see China indices benefiting from the entire movement. Also, if we look at Japan indices itself, Japan indices fell greatly because of this political scandal this year, and they actually triumph on Abenomics. So if, like example, all to be resolved and with further strength in the Japan economy, I don't see how US indices weakening is going to impact the Japan market, because right now Japan market is also quite independent, and we can see that the two largest Asian markets don't fully track the US markets itself.
Okay, we'll take one last question. I think this is quite an interesting question. To what extent will the rising bond yield impact the US stock market?
Okay,
To what extent will the rising bond yield impact the US stock market?
All right, so with regards to that question, and if we look back in what happened in the past, every time there's a stock market crash, you can see bond yield being at its highest because of the fact that people it makes it more attractive for people to switch from equities to bonds, because people are always balancing between these two major assets. So if like bond yield rise too high, it will really be one of the telltale signs that US indices may start to correct and that fund flows may occur, because you must understand that main fund flows are actually from companies, and companies would sense that this is a sign of danger and they may want to protect their existing funds and may go to safer assets like bonds and everything like that. So it's quite correlated, and people may want to keep a close eye on rising bond yields, because that is one of the telltale signs of a market correction.
Okay, thank you for joining us at our seminar, our webinar. I hope that you have benefited from Samuel's presentation. We have another webinar on US indices coming up on 22nd of May. Most of you should be receiving the invite. If you don't let us know, you're welcome to join us on 22nd of May. Thank you and have a very good evening.